Harsha Upadhyaya joins us, presents Kotak AMC. Harsha, good morning. Thank you for joining us. Harsha, the news for NBFC space stroke the financial space is just not improving. Whether it is DHFL or Yes Bank or Indiabulls Housing Finance. What is your understanding of the concern, the problem and the situation here? I'm not requesting you to comment on what the future of Diwan Housing or Yes Bank is, but in generally, we all read the headlines. And the headlines are telling you that problems are not over.
Good morning, Nikunj. Clearly, the pain points are still there in the entire NBFC space. The reason being, initially the problem started with the asset liability mismatch, and the liability side there has been a complete freeze. I don't think many of the NBFCs are getting either the bank lines or lending from MF, and they are also not able to raise money through other sources at this point of time. So in a way, their liability side is always has been a difficult one. And at the same time, in some cases, we have also seen some of the asset quality issues or governance issues coming up, which adds to the whole problem. So, and every few weeks, if you hear a negative story on one or the other NBFC, then to that extent, normalization in the debt markets is also unlikely to happen at a faster pace. So given all this, I would say that next couple of quarters are going to be a difficult period for most of the NBFC names.
All right, looks like it's going to continue to be difficult. Harsha, is that pain or is the difficulty going to exist perhaps all around? We've been talking extensively about the slowdown, and while there have been a fair amount of comments coming in expecting a pickup perhaps in a quarter, something too, what's your opinion? How dire do you feel the situation currently is?
While there has been a visible slowdown in the economy, more pronounced in the consumption side of the economy, our view is this is likely to continue for some more quarters. And once you see normalization of fixed income market, that's when all the businesses that require working capital or money for growth will be able to source that money, and that is when slowly the economy would start recovering. At this point of time, only the better balance sheets or better businesses are able to access money, and usually they are the ones who don't need so much of money for growth or working capital. And it is the basket which is down the curve which actually needs more money and which is also more leveraged at this point of time. And that's where the benefit of lower interest rates has not really happened, because the transmission has come to a standstill. So until that revives, we cannot really expect a large and pronounced economic recovery.
Large positions has been cement, a complete proxy to economy. But consumption is slowing down. Investment cycle is yet to pick up. There is a global slowdown. Exports are dwindling. Could you be forced to relook at your positions in cement or even corporate banks, because they are proxy to economy? And let's be clear, I really hope economy recovers, but to hope that economy will recover in a V shape by December, I think that would be a very naive assumption. So would you be looking at revisiting your complete economy proxy stocks and sectors?
Nikunj, we have already done that to an extent, and we still find more value in some of these infrastructure or economic activity linked stocks rather than the consumption side. While there has been a slowdown which would affect both the sides eventually, but today the consumption side is witnessing a lot more slowdown compared to some of these economic activity or infrastructure activity linked stocks. And also the valuation differential between these two segments is very large one. And we believe that as long as the consumption sector continues to underperform as against market expectations, there is unlikely to be any valuation support for these segments. And in our view, there is a visible slowdown which is not really built fully into analyst expectations in that segment. Whereas in case of some of the other names that you took, at least there is a relative valuation comfort. While the growth may still slow down for some of these proxies of economy, we believe that valuations are not as high as what you would see in the consumption basket.
You have a large exposure to chemicals. I'm revisiting this space once again with you, Harsha, because there's a large block deal in Russian chemicals. SRF, PI Industries, both these stocks are at a record high. Now, chemical may sound like a very boring space, but that's where there are a lot of specialty chemical companies, there are a lot of generic companies, there are pharma chemicals, there are chemicals, there are industrial chemicals. Give us some thought on, when you say you like chemicals, what exactly do you like chemicals? Agrochemicals, industrial chemicals, specialty chemicals?
We have had exposure across our portfolios in different names, specialty, agrochem, and even pharma-related chemicals. And we believe that this is a space where there is a short-term opportunity which is coming because of the environmental issues forcing some of the Chinese facilities to shut down their production, which means the demand being same, you will see a lot of export opportunity for some of these names depending on which segment of the chemicals they are operating in. And also from a medium to long term perspective, we believe that there is another large opportunity that is opening up, which is happening because of the kind of tensions that are there between US and China in terms of trade relations. A lot of global majors which have also seen consolidation, and they are looking at having outsourcing from regions other than China, because today they outsource from either one or two manufacturers from China for their intermediates. And if there is a tension between two countries, and if there is a chance of disruption in terms of those supplies, or if the cost is going to be very high at a future point of time, then obviously some of these global majors would look to diversify their intermediate base. And that's where I think at least some of the Indian chemical companies would start to figure in. I'm not saying that the entire Indian chemical basket would get an opportunity like this, but at least the ones which have better quality, which can stick to the supply timelines, etc., and which have scale to really compete with some of the global majors, would be the ones who will get a medium to long term export opportunity. So these are the two factors that we have in mind, and that's where we have taken some positions in the chemical sector.
Harsha, morning. Just wanted to understand, the sector that's certainly been in a limbo has been the consumption space. Questions about recovery continue to arise. And when do you think it could potentially happen? When could we see the impact of the monetary stance play out? Because we are certainly working with a low interest rate environment, which should bode well. Do you think it'll be in the festive season by the end of the year, or perhaps take longer than that, stretch into next year?
This is exactly what I was trying to explain initially, that while the interest rates have been low, as you clearly mentioned, the transmission has not been taking place. And there is also room for further interest rate cuts as global liquidity is abundant and global interest cycle is also benign, and our own inflation is also ruling quite moderate. Given all this, the interest rate scenario looks quite benign for Indian context. But the problem has been more of transmission. I don't think the transmission has been taking place, and it's difficult to put a timeline in terms of when the transmission will start to happen. But I think it's going to be a very, very slow grind over the next couple of quarters, and that also depends on no further accidents from the NBFC space, because as the market tries to normalize, if there are more accidents from NBFC space, then obviously that will delay the overall normalization process as well. And another point to note is, in most of the consumption segments, especially the discretionary consumption segments such as auto, there is a lot of inventory that is still lying with either the dealers or distributors or even the manufacturers. So to that extent, there is no hope for revival of demand, at least in the immediate term, and we will have to watch this space closely over the next couple of quarters to understand where that inflection point would come from.
11% down now for Yes Bank. 11% down for Yes Bank. Harsha, would you be looking at utilities? Would you be looking at buying a NTPC, Power Grid, purely because interest rates are likely to come down?
We have got an overweight position on gas utilities. Between power utilities and gas utilities, our preference has always been gas utilities, given the fact that there is going to be a medium to long term growth trajectory for gas. Gas being a cleaner fuel, I think that tilt is always going to be there. Whether it's Indian government or any government in the world, everybody is focusing to reduce environmental issues. So I think given a choice, it's better to look at gas utilities rather than the power utilities at this point of time, because the lower interest rate scenario would benefit both of them equally.
Air case scenario, Harsha, is it valuations, is it global trade war, or domestic slowdown stroke liquidity? Where do you think markets are not prepared for a shock wave?
I think clearly a market is not prepared for a liquidity shock if it happens. At this point of time, we don't expect any change in either global liquidity or domestic liquidity. But I think for some reason, if you see that happening, then I think the current valuations may not sustain. Why do I say that? Clearly, today's valuations are slightly elevated as compared to long-term averages. And that is sustaining because of the money that is coming from foreign investors, as well as the structural change that has happened in Indian context, where money is moving away from physical assets and coming into financial markets. So these two have been in combination helping the markets to sustain a slightly elevated valuations. And if you see any change in that liquidity trajectory, there is a risk for the market.
I want to understand your view on IT. Not playing it as a defensive, but you are looking at some of the bigger names there being performers over the next 18 months. Not concerned with regards to the kind of tremors on growth that we've seen with regards to global markets and also on volatility on the currency. What's making you so confident on the IT names?
We have an underweight position on IT names. We have just stock-specific positions there. As far as the entire sector is concerned, we believe that there are some verticals which are slowing down, and there are also issues in terms of whether the Indian IT companies have the right business model to take on the future expected growth in the digital space. And as you rightly mentioned, the currency, which can be a short-term tailwind, is unlikely to be a great tailwind for IT sector at this point of time. Given all this, we remain underweight on the sector, but we do have a couple of names where we believe some of these issues are unlikely to play out, and hence we are more positive.
Okay, just let's mark the markets at this juncture then. It's continuing to look tempered, and yet again you're seeing that underperformance from the mid-cap end of the market, down 0.5%, while things are looking quiet for the frontliners. Without a doubt, that breadth is skewed in favor of the losing side, and some of the stocks that are bearing the brunt, apart from Yes Bank, is Mindtree, which is continuing to look rather wobbly in trade at 687. You've got Cox & Kings, which continues to be hammered in trade. That stock is now 18 rupees. Care Ratings as well, with the management exit or being asked to leave, is currently under pressure. Torrent Pharma as well, on the back of news, is currently at 15.28. You've got Reliance Capital, Reliance Infrastructures, as well as Power. So the ADAC basket looking tempered. Bharat Forge, along with something like BEL, Allahabad Bank and REC, are under pressure. In fact, Harsha, we were having an interesting discussion earlier this morning with respect to the high PE stocks, just dissecting some of the names within the consumer staples industrial sector, the likes of Gold Properties, Info Edge, and the kind of year-to-date return they've had versus the likes of Lemon Tree, Avenue Supermarts, which have had it fairly rough in comparison. What's the view, and where do you see value within some of these high PE stocks?
See, clearly, high PE stocks carry some amount of risk, especially in a scenario where overall economy is slowing down. If you witness any slowdown in any of the names where the valuations are very high, then there is a risk of one, earnings downgrade, and a multiple contraction both. So to that extent, I think you have to be very careful in selecting some of the high PE or high valuation stocks at this point of time. That's where on the consumption side, at least, we have been very, very careful, because that's where the slowdown is in front of us. And if that continues, some of the valuation could be at risk for some of these companies.
India at a 52-week high. HDFC AMC 52-week high, HDFC Limited 52-week high, Pidilite not far away from there. Trent is sitting almost at a 52-week high. When do you think, Harsha, this market's obsession with near-term visible growth stroke corporate governance will change? You know, in any market, 50% of the market does better than the index, 50% of the market underperforms the index. But now we are looking at what 3-4% of the market which is doing better than the index. How long this trend will continue?
I think again I'll go back to lower interest rates and transmission of lower interest rates. I think that's when broader market will start to get funding for growth, and that's when more likely that you will see broader market participating in the overall upside. Today, one, there are very few stocks which are consistently delivering earnings growth, and two, there are far fewer names where there is no management or governance concern. So to that extent, people are moving their investments into some of these names where there seem to be a reasonable degree of risk protection. Going forward, when you see lower interest rates getting transmitted and helping most other businesses, then slowly the expectations on earnings growth for that basket will also improve, and that's when you will start seeing some money going into that segment. But I would say that for the next couple of quarters at least, it's going to be very, very stock specific market. I don't think you will see a broad-based rally at this point of time. And when there is a likelihood that economy is going to turn around maybe over the next 3 or 6 months, that is the point where people will start building in some risk in the portfolios and start looking at some of the names which are beaten down today but have a little risk in terms of funding, etc. So that is the point of time where they will start picking some of those names, in our opinion.
Okay, Harsha, appreciate your time. Glad you could join us.